Good afternoon, everyone. We appreciate you joining us this afternoon. We have Cliff Hodge and Jeff Carbone of Cornerstone Wealth speaking on the markets today. We're going to get started in just a few moments, so bear with us.
All right, good afternoon, everyone. Thanks for joining us today. Cliff, good afternoon to you.
Jeff, good to see you.
Hope you're well. Hope everyone is remaining healthy and safe as we shelter in place. However, we've got the reopening of America underway as we start the beginning of the month of May here. So with the reopening of America, we certainly are watching closely as we begin to get back to work or places of business, offices, parks, beaches, etc. Certainly something we're keeping a keen eye on, given what's going on. Today, before Cliff jumps into, as we have been in the past weeks, going over the market economic positioning of our portfolios, wanted to just spend a few minutes discussing active management style versus passive management style. And you've heard Cliff and I over the past month and a half or so. We spent time discussing the economic market conditions. We've pointed out in our prior calls that we've never been in a recession that has been caused by a government mandated shutdown as we've been under due to a public health concern. And let me tell you, we are in a recession as we can see, and we may not formally be in what's known as a recession, which is 2 negative quarters of GDP, but the economic data is showing recession. Not all industries, however, have been impacted the same. We've seen some have taken a pretty good, the brunt of this and severely been their prices of stock, earnings, et cetera, has come down. Some are weathering through the virus, and we're seeing some even thrive based upon the conditions we're under right now. You've heard Cliff in a prior call discuss market sectors such as energy, financials, and industrials, all down for the first quarter. Starting with energy, 51, financials down 28%, and industrials down 25% in the first quarter. We've seen the ones that were weathering the storm, such as technology, healthcare, and utilities, down 11, 12, and 14%. And as I mentioned, we've even seen a couple technology companies that were positive. Diversification and allocation of one's portfolio does matter. We continue to follow a process of an active management style. What that means, we often tilt our portfolios based upon what the economic and market conditions or data is telling us. We may even sell some equity positions and then hold some cash, as we are now, for a period of time for future investment. We are long-term investment focused. We want to make wise decisions in the short term, but we are long-term investment focused. As an active manager, we have taken some additional steps in the portfolios. We've overweighted certain sectors, we've underweighted others, In addition, we've also taken positions or changes in our individual stock portfolios based upon the reviews on earnings, expected earnings, the credit risk, dividend payments, etc. We continue to look to separate the bad from the strong. In contrast, from the contrast to active management that we employ, a passive manager will tend to own the entire index. By doing so, you're essentially owning, as I mentioned, good, bad, and the ugly. You'll take the full ride down, but you'll take the full ride up. And as the stock market volatility continues with the world fighting the COVID-19 virus, the economic impact of the restrictions and shutdowns around the world is still coming in. We continue to follow our process to get through the crisis, and as we've mentioned before, look to emerge in a better position as we do recover. So with that said, Cliff, I'm going to turn it over to you, as we have been in the past couple weeks talking about the markets. So unless you're going to pull an audible on me, Cliff, today, let's start with the markets today, okay?
Thanks, Jeff. And no audibles this week. We'll stick to the script, hitting on the markets, the economy, what we're seeing there, and then lastly, positioning and process. As everyone knows, I'm a big data guy. So this week's a little heavy on charts, but we'll try and move through them pretty quickly. There's a lot coming down the pike that I think is worth mentioning as we continue to navigate what's ahead. Jeff, really quick, just want to make sure you can see my screen share here with the presentation.
You're good, Cliff.
Awesome, great. So with that, we will dive in. So a lot of colors on this page here, but essentially we're just looking at returns of various markets over different time periods. And to Jeff's point, I mean, this really drives the point home for why we are active managers and why we believe that over a full market cycle, active management, it pays to have a process and to follow your process. Because just looking at the S&P 500 versus the rest of the world, down essentially 11 year to date versus 20 outside the U.S., both in developed and emerging markets. But even from a sector perspective, you can see there's quite the dispersion with technology actually up year to date. Contrast that to energy, which while it's had a great run over the past month, is still down nearly 40%. And so what we're seeing here is again, we hit on this last week, a larger and larger concentration of, pick your acronym, the FANG stocks or the FANG, your Facebook, Alphabet or Google, Amazon, Apple, Microsoft, making up a larger and larger part of the S&P. They're concentrated predominantly in this technology and some in communications, but importantly in these growth and momentum buckets. So you're really seeing a dichotomy between the more growthier areas of the market and really everything else. What about from the index level? So again, here we are today. This was updated this afternoon, so it's slightly changed. We're down about 65 basis points today, but we've been fairly flat for the past couple of weeks with some volatility in there, but we've really been surprised by, again, the speed and strength of this rally. After dropping 35, we're up nearly 30 off the lows, but still down around 15% from the all-time highs earlier in the year. Just how fast has this rally been when you compare it to other times in history where we've had bear markets? As you can see, it's the fastest by quite a long shot. We did 30% in 15 trading days. Compared to the average of 15 and 34, and then highlighted here 2008, 2001, the last two recessions. So again, it's important to remember that bear market bounces are normal. Just this one, the speed and strength has been a bit surprising. A little grainy on this chart here, but we can talk through the key takeaways. So what this does is that it puts our current market in perspective with, again, other infamous crashes or bear markets, if you will. So the black line is current day. 1929 is this dark blue here. 1987, the bright red, and then 2008, the dark red. So this is 100 days prior to the peak. So you can see that they all essentially started their waterfall or their crash effect at the same time period. And it's instructive to see what happened in other periods. So in 87, for example, you can barely see it here, but we did get a pretty quick retest within about 40 trading days before finally piling onward higher from there with a bit of volatility. That's important because that's the one period of the three that does not have a recession. 2008 is again this dark red line. The ultimate bottom wasn't put in for about 115 trading days after the initial sell-off. Similar deal for 1929. I mean, it was almost a year after the initial crash before the ultimate bottom was put in. So, while the speed has been strong or the levels have been strong and it's been very fast, we're certainly not out of the woods yet. Valuation supports that as well. As we've talked about on the calls, from a PE perspective, again, which is the price of the S&P divided by the earnings. This instance is next 12 months, so this is based on Wall Street estimates. You can see that from a valuation perspective, highest level since 2001, 2002, which is coming off the dot-com bubble. So, clients and advisors, we're having lots of conversations about, if you're sitting on some cash or if the levels of cash that we have in the portfolios, when's a good time to get back in? I would say not while the S&P is trading at these multiples. And not that we're market timing, but we're again following our process and trying to exhibit some patience. 2 out of those 3 Ps while Jeff and team handle the planning portion. So this is a busy chart here, but it's retail fund flows. So what this shows us is that retail has been very active in buying the quote unquote dip or the March, the February and March crash. Technology has seen a very steady increase in flows, along with energy, which is interesting, and then to a lesser degree, but still rising healthcare. So retail is piling in. Institutions are beginning to pile in as well. So this is from Credit Suisse. This shows equity long short funds, their net exposure. So higher means they're further net long, lower means less. So obviously we're back up here at all-time highs relative to where we were in 2018. Just means that the air is getting thin, right? So you've got a crowded trade. Nosebleed valuations typically does not spell positive for equity returns on a forward-looking basis, especially when you consider the earnings in the economic picture. So through about 2/3 of the way through earnings season, sales are flat. Earnings per share are down 9% year over year, led by the banks, which about all of the banks and financial companies have reported to date down 37. Material stocks down 30. Consumer discretionary down 16. Amazon being really the one bright spot there. So again, another data point that illustrates the benefits of active management. Whereas the more defensive areas of the market, utilities, real estate, technology, not so much, but healthcare are the more defensive areas, right? So you can see that the market is paying up for tech and protection, and that's really how we've been positioned by and large through the sell-off, and we'll continue to reevaluate as we move forward. Last but not least, in the market segment, just a peek at earnings. So this is what we did last year on the S&P 500, about $152 a share. Point B, our current 2020 estimates, down around, I believe, 19% last we checked. But C and D is where you superimpose the last 2 recessions that we went through. So the dot-com bubble was here, the global financial crisis way down here, goes to show that the street, their earnings expectations are still elevated for 2020. 2021 is just on another planet. We're going to magically eclipse what we did at the peak of the cycle with unemployment at 50-year lows, coming off tax cuts, deregulation, so on and so forth. I mean, these numbers are going to have to come way down, which means that absent an equity market correction, that PE ratio that we talked about is just going to continue to get worse.
Well, thanks, Cliff. I know you shared a lot of data there, and we realize, again, some of the charts are probably a little bit blurry and it's hard to see, but I think you made some really, again, pointed out some great points based upon historical timeframes of recessions or crashes in the market, looking at reviewing the earnings. Those are the things we're continuing to look at. Before we move along, I just want to give a reminder and give a thank you to Dana Hicks for the question and answer area. So if there is a question during the presentation, certainly raise your hand or put it in. We'll answer them at the end when we do our recap. So thank you, Dana, for reminding me to give that heads up to everybody. So Cliff, let's move along. Let's go into the economy and what's your kind of some of the charts and what you're seeing there.
Yeah, thanks, Jeff. And from an economic perspective, still a pretty major focus on employment. So this morning we got the ADP employment survey, which typically comes out a couple of days prior to the government's official employment report, which will get released on Friday. As we can see, going back to the beginning of the data set in 2000, the worst report on record. 20 million jobs from the private sector lost during the month of April. And this is really the first half of April. So we anticipate that these numbers will continue to get worse as we move along through the coming months. But by and large, echoes what we're seeing with the claims numbers that we continue to hit on and that we get released on a weekly basis. So the rate of change is improving, but still last week, nearly 4 million people lost their jobs. From a continuing claims perspective, again, this is if you have to refile for unemployment after the initial period, up to 18 million. So, these numbers continue to pile up and they're mind-boggling. But we do get the official unemployment report on Friday. Well, we get claims in the morning, as we do every week. But then the NFP or the non-farm payrolls and the unemployment rate will get released on Friday. Current consensus expectations for unemployment are 16%, which is, again, there are no comps other than the Depression. But again, in reality, because of the timing mechanism of when the survey hits, it's likely more that it's going to be 20 to 25% is what we'll see at the bottom, likely in next month or July when we get the June data. So one of the many reasons that we care so much about unemployment that we'll highlight this week is that, as you can see in the data set here from Deutsche Bank, there's a pretty strong correlation between unemployment and Chapter 11 bankruptcy filings. So we're really just scratching the surface here, as you can see. These are the estimates on unemployment. You're starting to hear some rumblings from some of the major corporations in retail. Neiman Marcus, J. Crew just announced that they're going to be filing here in the near future. Hertz Rent-A-Cars is another one that they're talking about bankruptcies. But again, there's a whole bankruptcy cycle that we have yet to go through. We're really just scratching the surface on that. So again, another reason why we're continuing to remain patient and prudent with our investment portfolios. But it's not just the major corporations that are feeling it. So this chart is from a survey from a company called Alignable, which is it's an online small business networking group. But what they found was that among their survey participants, 84% of small businesses are going to be paying 50% or less in rent for the month of May, with 40% not paying anything at all. So this is a pretty startling number. Now, if it's 1 or 2 months, all the stimulus that we've been getting, can help bridge the gap. But anything sustainable is going to have some pretty serious ramifications as it flows through the economy. And it's not just the business side; it's also the consumer side. So as of the end of April, 7.5% of mortgages have gone into forbearance. So roughly 4 million households are not paying their mortgage at this point. Some of that is likely due to people wanting to be cautious and put away some additional cash. But again, not great signs for making you feel all warm and fuzzy to get aggressive buying energy stocks, buying airlines, buying these cyclical components of the S&P. If you look at it from the broader economic perspective, here's that update on the weekly economic index that we've been running through each week, and we're not seeing any bounce, right? There haven't been any bounces in the data yet, down 11.8%. Again, just pales in comparison to what we saw during the global financial crisis from a magnitude standpoint. Not seeing a bounce in the data, but we are seeing a bounce in the S&P, obviously. And Jeff, one of the main questions I get is, well, why is the S&P rallying while the economic picture looks so dire? And really, I think it's two things, right? So one is stimulus. So this is the total assets from the Federal Reserve's balance sheet. You can see prior to the great financial crisis, there's about $1 trillion in assets in the balance sheet, and that has exploded up to 4 trillion, below 4 trillion where we began the year. Now nearly 7 trillion worth of balance sheet expansion from the Federal Reserve. So this is money that has been pumped into the system in the form of quantitative easing. It's up to about 30% of our GDP. So it's just a staggering amount of money that's coming into the financial system. So that's from the Fed perspective. Also from our federal government, the Treasury just announced that they're going to borrow $3 trillion for this quarter, which is 5x of what the previous record, which was back in 2009 from a quarterly perspective. So there's just a lot of financial lubrication, a lot of payments trying to bridge the gap that are flowing through the system and flowing into the equity markets. And then the other, Jeff, as you mentioned earlier, is the reopening, right? So as of Monday, about 60% of the nation is under a stay-at-home order, down from the peak of 95, with plans in place already to get back to a more normal level by the first week of June. So the stimulus, the reopening, we've seen a flattening of the curve in infection rates. Now, those are all positive signs, but it's this push-pull of stimulus versus economic gravity, and we are still in the camp that ultimately economic gravity is something that we're going to have to deal with before we can make a sustainable bull market.
Well, thanks, Cliff. I mean, you just like with the market, you shared a lot of economic data there, talking about with consumers, unemployment, the stimulus that we've received both throughout from the Fed as well as from the government itself. So let's kind of, and you hit it on a little bit, but let's talk about our signals that we're continuing to watch and the signs, as well as how we're positioned and why we're positioned where we are.
Yeah, absolutely. So again, within our process, it's never just one thing. So we don't only focus on the S&P. We don't only focus on the Dow or earnings. I mean, it's a mosaic of not only what's happening in equities, but what's happening in broader financial markets really across the globe. So one of the more important areas that we continue to track are yields, right? So this is the snapshot of the 10-year Treasury yield going back a year. This is from yesterday. It's actually up. We got up to about 70 basis points today, but so moving in the right direction, but we need to clear 80, 90, 100 plus for signs that the fixed income market, which is a lot larger and more broad than the equity markets, are buying into this reflation story. High yield spreads, which again are a measure of confidence in the corporate landscape. It's the difference in interest rates on high yield bonds, aka junk bonds, versus their treasury counterparts, and still just kind of stuck in this 750 to 800 range. We want to see these again break down 600, 500 before we really feel comfortable that normalcy is returning to the fixed income markets. Similar pattern here with investment grade credit. We see that just kind of being stubborn around that 200 basis point number. The dollar, king dollar. It's interesting. We talked about the $3 trillion in additional stimulus from the Treasury, the $6 trillion Fed balance sheet, but the U.S. dollar is still high. Actually, was up today on some of these. So I think it's very telling the fact that rates are remaining low, the dollar is remaining high, but our central planners are throwing the kitchen sink from a stimulus perspective. This another data point that highlights the caution in both the FX and the rate markets, which again typically have leading indicators for the economy and for equity markets over longer periods of time. We are getting a bit of relief in the commodity space, which is green shoots, if you want to call it that, driven largely by oil. So this is quite volatile. I think we're around $24 a barrel as of the close today. But again, we need to see some stability. We need to see this base and then continue to move higher, as oil is another leading indicator of the economy. So it is showing that the worst may be over, but it's still too soon to say whether or not this is sustainable or whether or not it's a head fake. Similar deal with copper, Dr. Copper. Moving in the right direction, but too soon to say definitively that the worst is behind us. And then last but not least, equity volatility as measured by the VIX. Off the highs, but we were looking at this earlier in our investment committee meeting. We're still 2 standard deviations above average, which the longer run average is somewhere around 19. So we want to see this thing break down below 30, break back toward 20. Again, with the confluence of these signals guiding us as we look for the start of a new bull market, just not seeing it. So we'll continue to pound the table on patience. That's really that's the key message. But just briefly before I hand it back to Jeff to close, just a couple of comments on positioning. We're still remaining defensive. We have done a couple of things here and there in some of the more tactical equity portfolios, as far as individual names or stories that we found that become attractive. In fixed income, we have increased some of our holdings to treasuries. So again, government bonds, high quality, exposure to potential lowering in rates and growth. Still maintaining elevated cash positions or what we call shadow cash in the form of some gold, some US dollar ETF, things of that nature, to try and get a little bit of return while we continue to monitor the situation as we go through this part of the cycle. So with that, I will turn it back to Jeff, and I know he's got some remarks, and we'll see if we have any questions.
Well, thanks, Cliff. Again, thanks for your focus and dedication. Thanks for sharing the information. I know, again, like we said, it's a lot, but we do have a couple questions here. I think some of it, this is from Will. What long-term impact do you see the $25 trillion national debt, and how will that influence any investment planning decisions?
Yeah, that's a great question. So I think you have to look at it like investment related from various time horizons, right? So in the immediate and intermediate term, we still have quite a bit of runway from a debt perspective before it really becomes an issue. You look at Japan as an example. Their debt to GDP is 3x, 2.5, 3x what ours is. I mean, I think they're 2.5 to 3 times percent of GDP in debt right now. So we could still do quite a bit more. And I think ultimately we're going to have to do quite a bit more before all is said and done. From a longer term perspective, I think there are a couple of things. One, so debt is essentially borrowing from the future, right? You're taking from the future to help fund spending today. So high levels of debt are they act as an anchor for economic growth, right? So as our debt continues to pile up, I mean, it's going to be harder and harder for us to have these 3, 4, 5% GDP growth rates going out into the future. But secondly, I think also, at some point it's going to lead to some pretty serious inflation, right? So if you think about from a fiscal perspective, how do you get out of this debt? That's you either A, put in some sort of a forgiveness program or a debt jubilee, or we just say, hey, China, you caused this virus, and we're not going to pay you what we owe you. I don't think that's on the table at this point, but never say never. Or 2, you have to inflate your way out of it, right? So that means your currency, relatively speaking, becomes a lot weaker, because in real terms, that debt then becomes less expensive, right? So, inflation, I think down the line, I think, right now we're more worried about a deflationary scenario than we are an inflationary scenario. But 3-5 years down the line, once we get back to normal, I think we'll see higher than we've seen 2% inflation over the past decade. I think there could be a structural shift higher as a result of the debt. Sorry, kind of long-winded, but
no, that was great, Cliff. Thanks. And I think this is a little bit of a carryover on that. It's how will the stimulus efforts affect taxes, inflation, and the national deficit? I think you answered some of that, but any other thoughts on the stimulus? And
yeah, I mean, taxes are going to go up, right? Maybe not under the current administration, and maybe it's not personal taxes, but so either A, taxes are going to have to go up, or our spending programs are going to have to come down, right? Our entitlement programs, whether it's Social Security, Medicare, Medicaid, you name it. It's unsustainable. But again, at this point, we've got a lot of other issues to deal with before we get to those. So in the immediate and intermediate term, I don't think it's much of an issue, but 5, 10, 20, 50 years out, things are going to look a lot different.
And Cliff, I'm just going to add on to that. So when you think about our tax program today, we're probably in the lowest tax situation we're going to see for a while. Doesn't mean it changes, tomorrow or next year or 5 years, 4 years, 3 years, whenever. There's definitely, but to your point, taxes will have to go up. That's a lot of what, from an advisory standpoint or advisor perspective, we're discussing what tax strategies can you be utilizing today to improve your situation for the future, because to your point, and the question with the national deficit, stimulus, everything that's being thrown at this virus and this crisis, it's going to be a foregone conclusion. There'll be adjustments in the future. So we'll have to keep an eye on that and continue to watch. But I think that those are the questions. So thank you for those coming in. Again, when we have our call next week, certainly you could send them prior or while during our discussion if anything piques an interest. Bottom line remains, we're not trying to time the market, as Cliff said, but we're watching the data. We're following our process as we continue to tout. We've been tested throughout history with economic, geopolitical, health crises before. They're never welcomed. And as we're seeing now in the crisis we're in today, they're devastating in many ways and with tragic loss. But they are part of our history. I do believe in innovation and in the ingenuity that we have will get us past this and will be part of our history, which is yet to be written. We thank you for joining us today. We wish your families, we wish you all safe and healthy week ahead. We'll look forward to talking with you again on our call next Wednesday. You'll also have some emails coming regarding some other webinars we'll be doing regarding the 6 financial considerations, the emotional considerations of retirement. We'll be talking about quite a few different topics, so keep an eye out for those. Like I've asked before, if you want to forward those to friends, family, co-workers, certainly do so. I see some thank you for allowing us to work on your behalf. We appreciate your trust and confidence you place in us. Stay well, everybody. Have a good week.
Thanks, Jeff. Thanks all.